Hello, hello, Facebook, hello, YouTube. This is Daphne Jones, the Smart Money Chick, and hey, coming to you live again on. Haven't figured out a name for this live yet, but the plan is to go live every Monday, 1:30 p.m. Central Standard Time. Here, here on my page, here on my two pages, Smart Money Chick page, and my YouTube page. And so, as you know, here at the Smart Money Chick Central, we talk money. You know, how to keep it, how to save it, how to grow it. So I thought these 15-minute, I could come out and just talk to you about 15 minutes on one particular subject. If you got any questions about it, you can put them here if you're here live, or if you're watching the replay, you can put the questions on the page, and I'll get to them and I'll answer them. We can go back and forth. So today, what I wanted to talk to you about is life insurance. For transparency, I'm a life insurance broker. I'm licensed in multiple states. So the life insurance I wanted to talk to you today about is whole life insurance, traditional whole life insurance. I may compare to some others, but it gets a pretty bad rap in the just like on the net and among folks today, that it's a waste of money, it's a bad product, and that's not the case. So traditional life insurance, whole life insurance, came about. It was the first insurance that was offered, first life insurance that was offered. And so the way a traditional policy is set up, of course, there's a death benefit that you're beneficiaries, and beneficiaries are individuals who you designate to receive your death benefit. Upon your death, they receive cash, tax-free lump sum of tax-free cash to use as they see fit. So you pay a premium monthly or quarterly, however you choose to. And so this premium is broken down into three parts. One is the cost of insurance. It's what the actuaries, these are the people who figure out the cost of what they think, what the numbers say when you're going to die. They set the price, and for a traditional life insurance policy, a whole life insurance, that cost doesn't change. Your premium, your cost of insurance doesn't increase or decrease. So you won't receive any future surprises for adjustments. Then a small portion of the premium goes toward just administrative costs. That's not much at all. And then the rest of the premium over that goes into a cash accrual account. So on this account, the insurance company agrees to pay you a certain amount of interest. This can be, I've seen it from 2%. I've seen it as high to 5 to 6%. So this is something that they agree to pay over, again, the life of your policy. As long as you pay the premiums, they will pay you this percentage on your cash within the policy. This compounds. It's not just simple interest. It compounds. Also, another way that your cash account grows in traditional whole life insurance policies, if you purchase the policy with a mutual insurance company, such as the name we all know, Mutual of Omaha, you also receive dividends paid into the cash accrual account. So paid into your cash account. So dividends it's cash, and dividends are declared by the board of directors of a company. Most of the time you hear them in reference to stock, and they're paid out of profits. And this money is placed in your account. It is also subject to interest, to the compounding interest that the company has agreed to pay you. So it's a pretty good, it's a great way to grow the cash accrual. So often what you hear bad mouthing whole life insurance policies is that there are other ways, there are faster ways to grow money. This is not an investment and so forth. Well, that's true. Insurance is not an investment, because investments imply risk. There's no risk with insurance policies. So they're not investments. They're savings plans, and pretty good savings plans, as a matter of fact. So because, again, this interest is guaranteed, then you have the money coming in from dividends. So often ask, well, it doesn't grow fast enough. Well, again, that goes into how the policy is structured, how you and the agent that you're working with, the broker that you're working with, structured the policy. And what do you want it to do? Do you want it to be a base life insurance policy? I want to make sure that a death benefit is paid if I leave here. And then that's fine, because that's what it's designed to do, and that's what it'll do. Now, if you want to use it as a savings plan, you want to take advantage of the compounding interest, which is very good, then you'll do something that is called overfunding your insurance policy. And overfunding is, remember we talked about the premium. And in a traditional life insurance policy, the premium does not increase. You won't get an October surprise. You won't find out 6-7 years later that you need to pay more into the policy to keep the policy active. Whole life insurance policies don't work that way. But if you decide to use them as a savings vehicle, many of you have heard the term infinite banking or be your own banker. Whole life insurance policies are the instrument that allow these type of things to take place. And you're able to do this because you overfund the insurance policy. You pay above the premium. And that can be quite a bit of money that you can put into an insurance policy. There are some governmental limits, sure. Uncle Sam has rules for everything, but you can put quite a bit of money inside an insurance policy. And again, it's going to grow at the interest rate that it is guaranteed. These are traditional life insurance policies, whole life. I'm using the words interchangeably, but they're whole life insurance policies. So again, you can overfund them, which is to put more money into them than is required by the premium. The premium doesn't increase. So the premium stays the same. The cost of administrating the policy stays the same, but your cash accrual account grows much quicker because the 4% or whatever interest that you're contracted, you're putting more money in there. It grows quicker. Also, that affects the amount of dividends that you're paid that are declared by the company. So therefore, you have money to take part in infinite banking or be your own banker. So you know what? Since I brought those phrases up, and we've still got about 7 minutes, I'll go into discussing what it meant by those phrases. So in the concept, as I understand them and from my research, is that when you need to borrow money for purchases, whether it's for your own business or just you need to borrow money for whatever reason, that you borrow from yourself, and that instead of paying bankers interest to banks or other finance companies, that you pay yourself the interest. So that's the concept behind infinite banking and be your own banker. So remember I told you that you can overpay your premium and start your cash account off, and it gets pretty large. And let's say at some point you want to borrow, let's say you want to buy a car cash and you want to borrow $10,000. So we'll keep the math simple. So you have more than that in your cash account in your life insurance policy. So you go and you borrow the $10,000 from yourself. Now, it is best that when you're using the principle of infinite banking or being your own banker, that you charge yourself market rate interest. Put the money back in there. Do you have to? No, you don't. But that would defeat the purpose of using your insurance policy as a bank account. You have to put the money back in there. And not only to put back the $10,000 back in there, but to charge yourself interest. Market interest, whatever it is. right now for car loans or what have you. You charge yourself the interest. And that's the money you put back into the account, so that the account, it keeps performing up to the level that you want it to. So the money stays in there, and it's constantly growing. You're taking advantage of the compounding interest and so forth and so on. So that's infinite banking in a nutshell. If you all want me to go more into it, do a 15-minute deal on infinite banking and being your own banker. Again, post on the page, like the page, interact with me. It's no problem. I'll get more in-depth information for you. But that's the attractiveness. That's the attractiveness of whole life insurance policies. That they're stodgy or out of date or something of that nature. No, they're not. I think they've gotten a bad rap because often individuals pay into these policies exactly what they're required to pay into them. So you may start off with, say, a $25,000 death benefit that you pay $40, $50 a month for, and you've done so for 20, 25 years. And then the beneficiaries, they receive the $25,000 death benefit, but there isn't much cash accrual in there. Well, that's because you simply used it as a life insurance policy. And that's fine. That's not a problem, because that's what it's originally designed to do. But if you wish for more cash to grow within the account, you'll have to put more in than the basic premium. So, but now an advantage of having a set premium is that the cost of insurance doesn't increase in a traditional life insurance policy. For instance, some of you may have or have heard individuals that use IULs, Index Universal Life Insurance policies. They're also a form of life insurance. But these are the kind of policies that, if they're not structured properly, this is where you get the October surprise, I call it, where years into the policy, 10, 12 years into the policy, it's discovered that the policy is about to lapse because your premiums need to increase. And that is because the cost of life insurance within the policy, remember the three things we talked about: administrative fees, cost of life insurance, cash accrual. The cost of life insurance within these policies increase yearly because it's not set. It's not a whole life policy. It's the portion that's the life insurance policy here is an annual renewable term. So actually every year the cost of life insurance goes up. So at some point, if you've constantly paid the same level premium for several years, eventually it's not going to be enough to support the policy because the cost of life insurance has increased. Every year it costs more to insure you, even though your weight hasn't changed, you don't smoke, anything of that nature. It's still going to cost more for you to get life insurance at 28 than it did at 25, and each year that it progresses. That's the way it is. So for individuals, you may have heard the horror stories about we're about to lose our life insurance if we don't come up with X amount of dollars. That's usually the case. So again, it's how you design those policies from the beginning. But I digress. They're not bad policies. They just have to be explained properly, and they have to be structured well. They're very useful. They're very useful, particularly for savings plans. Because they don't have a high guarantee of interest, but they usually pay interest based on indices. Like they may be attached to some mutual funds or something of that nature that generates a higher rate of interest, say, than the guaranteed anywhere from 2 to 4% that would be guaranteed in a whole life policy. So they do have their advantages. They just, again, knowledge, smart money chick. You're making decisions and you don't have all the information, or it's partial, or you don't have any information. I'm just signing up. My mom told me to get a policy and I got a policy. And that is the way that many of us jumped into financial decisions. So look, we're nearing the end of our time. It'd be great to hear from you. Hey, interact, like the page, interact with the page, come back. I'm always posting information, links to my blog where I put more information out there. I've got, I'm going to make sure I put a link down there. I've got an ebook that talks about insurance, some, comprehensive, condensed information on insurance. So I'll be looking to hear from you. So again, I'm going to get out of here, and I want you all to have a prosperous week. God bless America. Bye-bye.